Welcome to Real Estate Focus. I'm Calvin Law. Our topic is residential financing options. My guest today is Regina Tang. Regina has been in the residential and commercial financing business for a few years. She's from Loan Factory. She's going to be here talking about her expertise in different unique residential financing options for first-time home buyers and seasoned home buyers. Wow. Welcome, Regina.
Thank you.
Thank you for being here.
Much for having me here today.
How was your
Calvin.
morning so far?
Very good, very good. How was yours?
I'm glad it went well. Mine went well as well. At least peaceful, right?
Yeah.
Yeah. So thank you for being here.
No,
so
thank you.
Let's talk about the mortgage market right now. What you see out there, what you experience out there, and also how many times you think the Fed will cut rate in 2025?
So in 1981, the average 30 years mortgage rate hit like 18.63%. 18.63%. So now fast forward to today, we are seeing 6 to 7 rates, and folks are saying, is this the worst time to buy? But here's the truth. People bought homes at 18%, and they will buy at 6.5% too. Because real estate is never about timing it perfectly, right? The perfect time really shows up with the sign that goes, that says like, go now, right? It's all about finding the perfect timing for you and figuring out what monthly mortgage payment feels just right for your budget. So we are seeing people buying homes left and right as well, yeah.
That's fantastic. So there's a phrase people keep saying, don't wait to buy real estate. Buy real estate now and wait.
Yep, whatever fits your budget.
And homes are not a necessity, it's a need,
It's a
right?
need.
So it's a basic human or species needs as well.
Yep, people
So
have
you
to
buy
have a
with your
place to
needs,
live, yep.
right? And there is a shelter for themselves, for human beings, and for the family as well. Yeah.
Correct.
Oh, so let's share on my part. Let's share my information on the current real estate market. So what I see out there is the inventory is low because home sellers are holding on their homes due to low interest rates, and people don't want to give up the low rates and pay for the higher rates with higher mortgages, insurance, and then property taxes as well.
Right.
At least in New England areas, most home prices are pretty steady and stable as well. Plus, the cost of labors to build new homes are very expensive. A lot of people are aware that the tariffs are sort of scaring people.
Right.
And the tariffs will actually make everything much higher to afford and to build. So therefore, inventories are low because of those factors and other factors as well. And I don't want to go into it. I'm not trying to be political, but at the same time, it's all about real estate. So with that being said, can you share programs that you offer for, as I mentioned before, first-time home buyers and investors as well?
Oh, yeah, sure, my pleasure. So we have the FHA loans, right? We have the temporary 2-1 buy down, pay for the lender. Normal cost is like $5,000 to $7,000, but the lender is paying for that cost. And we have the home ready, home possible, like credits and lower interest rate for those who qualify. And we also have the 1% down payment. this is a conventional loan, just 1% down payment. But the maximum loan amount on that is $350,000. So 2% grant, and for those people who qualify, like you have to have a FICO score of 620, and the minimum requirement from you is 1%. And also, there's an income limit on that. So you cannot, so it's 80% of AMI, the average median income. So you can, like say if your annual income is more than that, you won't qualify for that program. And to find out the average median income, you can go on like the FennyMac.com to look it up. But just for example, like in the Braintree, like right now, the Braintree area, the average median income, it's $113,600 for the average median income. So if you make
for single borrower or for two borrowers?
Two borrowers in combined. So if you exceeded that, you won't qualify for this program. But it's like in the Worcester area, they have a lower AMI, like it's just about $89,000.
So based on geographic?
Based on county. Based on county.
Based on county. Based on demographic as well.
Correct. The location you're buying.
And when you mentioned about normal cost 5,000 to 7,000, what is that? How does it work?
That's a credit from the lender.
It's like helping the buyers towards the closing costs.
Correct. Yeah.
Got it.
Yeah.
And this is a great deal. 1% down.
1% down.
Okay,
Yeah.
yeah.
I had a client who took advantage of that, and then they were very happy about that.
And this apply to seasoned homeowner as well, as long as they live in the property
Yeah.
or use the property as a permanent residence.
Correct. Yeah.
Got it. And another program that you mentioned, what is bank statement loan program?
So those are
So like an ODOC?
No. So bank statement loans are called non-QM loan. So they don't quite fit into like the Fannie Mac or Freddie Mac guidelines. So those bank statement loans, basically, we qualify them by their monthly deposit. So we would need either a 12 months or a 24 months of bank statements to qualify them.
To see that
So those
the
are more
down
like a
payment-
self-employed or like 1099 clients or something like that.
Okay. So does the down payment have to be in the bank for 2 months?
Yes, but the bank statement loan, we have to have a minimum of 12 months bank statement.
12 months.
Yeah, to qualify.
Just to make sure that the money is safe in
Yes.
a U.S. institution
Yes.
or institutions, if you will.
Correct.
Okay. I mean, I think that this program is kind of rare. Not too many banks offer this type of program.
Yes, that is right.
Yeah.
Yeah.
Especially for business owners, independent contractors, or some sort of self-employed
Correct.
Borrowers.
Yeah, so other than the bank statement, we have tons of other loans, like so the P&L, the profit and loss statements from the self-employed individuals who want to purchase a home that way. And we also have like a very famous one, very popular one. It's the DSCR loan.
What is that?
The debt service coverage ratios, where like you probably, that's you don't have to look. We don't need W-2. We don't need tax returns. It's all we assess, like if really just focus on the cash flow generated by the property. So long your what they call a PITIA, if your rental income surpasses that, basically you're very good to get this type of loan. So in other words, the PITIA, like your mortgage principal, your interest, your taxes, right? And also if it's a condo, you have to pay a condo fee. Like say, all that adds up, like say $1,000, and your rental that you get monthly is like $1,200, for example. So you have a ratio of 1.2. So that's really, really good for this type of loan where we don't look at W-2, we don't look at tax returns, and all it is just based on the cash flow on the property.
So as long as there's a cash flow, I mean, it should be okay. Yeah, right.
So that's why it's very popular. It's very good for us.
Good. Yeah, that give home buyers and investors a lot of options
Yes, investor.
to look at different properties, or different type of properties.
They can grow their portfolio that way.
Awesome. Yeah. We talk about residential financing options with Regina Tang from Loan Factory. And we just work on a condo in Stoughton recently. So the buyers had a very difficult time of getting a conventional loan. Right. So I contacted you, and you were able to help him. This type of loan is called non-warrantable loan. So could you please explain what is a non-warrantable loan?
So the condo in Stoughton was a little tricky because that condo classified as a non-warrantable condos due to their, I think, what's the master insurance, right? So what that means is it doesn't fit into the Fannie Mac and Freddie Mac guidelines. So we had to use another, we had to use the non-QM, and we've had a lender that worked with the non-warrantable condos. And just back up a little bit, like the Fannie Mac and Freddie Mac, like they are like government-sponsored mortgage program, right? So that sets the requirements to classify a condo as warrantable or non-warrantable. So they buy home mortgages from banks, credit unions, and mortgagee or originator. So they either keep them, scoop them, or sell them. And because those non-warrantable condos are considered risky investments, so Fannie Mac and Freddie Mac will not buy them. So your buyer had to use a different way of financing called like the non-warrantable financing route to get that approved. So it makes it hard for a lot of banks because they don't deal with those type of loans, right? And then you go like, hey, what type of things that make a condo non-warrantable? So we deal with the master insurance, it was an issue, right? But there are other issues that could also classify as a non-warrantable condo. Like say, if one person owns like more than 10% of the units, right? Or less than 50% of units are not owned by the residents, like too much investors in the complex, right? So you wouldn't be able to get like regular financing, or the association has like litigations or like not have enough reserves, things like that. So that's why we had to use a lender that will take non-warrantable condos, like loans. And that's what we did, yeah.
Right, so that's why it's called unwarrantable or non-warrantable, because high risk.
It's high risk for the
lender.
For the Fannie Mae and Freddie Mac. So so
right. So that's why conventional cannot do it, because conventional is like very conventional, right?
Yeah.
So the owner occupancy rate has to be like
right.
50% and above versus investment units. And that's why it's called non-conventional, right?
Yeah.
So so that makes sense.
Because they have their own guidelines. There's so many checkpoints they have to, they have to meet.
Right. So yeah, that's good. I mean, we just talked about a couple of unique residential financing options already, and those will give buyers more options to
Absolutely.
purchase properties versus like conventional.
Yeah.
Because conventional loans, I mean, anybody can do it,
Yes.
right?
And,
So it's pretty
many-
normal. Yeah.
Yes, you see more conventional loans, but they're great, right? Because they
Low interest rates,
interest rate
a little bit
is
easier in terms of
easier.
process-wise. Yeah.
A lot of paperwork. So in other words, you need to show W-2, your 30 days pay stubs, right? Tax returns, things like that, and then making sure you have money in the bank, right? At least 2 months down payment in your bank account, things like that.
Higher credit scores and
Yeah,
no
higher
lapse of employment.
Yeah. So
Those are the goodies.
minimum FICO score would be like 620.
620, that's it?
Yeah,
Wow, that's pretty low.
620.
Yeah,
Really
nowadays
low.
it's pretty low. Even rentals, I mean, landlord asking for like 700 and plus, for
Wow.
credit score.
Yeah.
I have
So
a couple of landlords
conventional
asking for
loan-
like 750 and above
Yeah,
for rentals.
conventional loan is 620.
Wow, that's pretty low. Yeah, yeah. So
But with the FHA loan, you can go even lower, right? So
interesting. Yeah. And you mentioned about if people putting down payment less than 20%, there's a PMI. What is PMI?
PMI, so PMI stands for private mortgage insurance, right? So if you put down less than 20%, the lender require you to purchase that. It's because it protects them, protects the lender, right? In case you default in your mortgage payment.
And I think I saw the letters that you issue to buyers. Some of them name as qualification. So what is the difference between pre-approval versus pre-qualification letters?
Yes, pre-qualification is it's a little pretty much like you call it, like you state, like, hey Calvin, I made this such, but there's never been a proof on that, right? So, but with pre-approval that we give out, we'll need to verify the income, like say, okay, you're making X amount of money per month, we need to show like 30 days of pay stuff, right? We have to verify that. And we also need to see what you stayed for the down payment. So we need to see at least 2 months your bank statement to show you do have that much money. And we need to see like tax returns or W-2. So basically pre-approval is a bit more solid. Because we verify that, versus a pre-qual, anybody can state, right, what they made or what they have. So.
Yeah, as the listing agent, I usually look for pre-approval versus pre-qualification.
Yes.
Yeah, and when I see pre-qualification, I tend to vet the buyers more versus a pre-approval. But in terms of pre-approval or pre-qualification, in order to protect the sellers, I mean, the listing agent must vet both letters.
Yeah, that also
diligently.
shows, that the buyers are very serious about getting a home, right? If you, because if we don't verify, we don't know, like, when it's in the middle of the loan process, you will come into an issue. It's like, why was this not verified?
Yeah, it is important to do sufficient due diligence to protect all parties.
Absolutely.
In a transaction. Yeah, regardless of whether the buyers or the sellers.
Yeah.
It is the professional's duty.
Yes,
to
definitely.
do due diligence. And
Sure.
and do you do 203K loan as well?
Yes.
What is 203K loan?
So those loans are like money that like the buyer might need some assistance or some money to help with the rehab. It's a transitional loan that helps the buyers to get some rehab money to, to fix up the place.
And those apply to like flippers, investors, even primary residents as well, right?
Correct. Yeah,
okay.
That's correct.
Great, fantastic. Yeah, I think that's a wrap. So I want to thank you for being here.
Oh my God, thank you so much for having me, Calvin.
Yeah, so I hope you have fun, and thank you so much for sharing insightful information with the consumers and in general audiences out there.
Absolutely, my pleasure for being
Love to have you back.
No, thank you, Calvin. Thank you so much.
Thank you. Well, that's it, folks. I hope you find the information that we just talked about helpful to your home searching process or home selling process. I want to thank you for watching. Hope to see you next time. Take care.